Assalamualaikum warahmatullahi wabarakatuh. We are from Group 8. Want to present about comparison of conventional and Islamic money and capital markets. So this is our group member. It is prepared by HAFIZAH HAZIQAH, FARAH, QAMARUL Farhan, MOHAMAD ILHAM and Muhammad AIZAT. So in this presentation, we are going through one by one from introduction, first issue, second issue, third issue, fourth issue and the conclusion. Okay, so first is introduction. Islamic and conventional money and capital markets both shape the global monetary system. So both of these systems perform very important role, which is capital mobilization, investment support and economic growth. So they differ fundamentally in philosophy, ethics and legal foundations. In terms of conventional markets, they are driven by secular goals, which is profit creation, risk transfer and interest, which is riba. But for the Islamic markets, they operate under Sharia law, which is they emphasize ethical behavior and social justice. Islamic finance prohibits riba, gharar and maisir. Despite the differences, both of the systems are integral to global finance and have the unique strengths. So it will be good to understand this system to help analyze their economic roles, structures, products and the regulation.
Okay, so now I would like to present on the fundamental difference between conventional capital market and Islamic capital market, focusing on the underlying principle and foundation. So let's start with the conventional capital market. So conventional capital market are built on secular economic principles. They allow financial practices that are strictly prohibited in Islamic finance, such as interest-based lending, speculation, and investment in any legally permitted businesses. So regardless of its society or moral implication. The primary objective of conventional capital market is profit maximization and market efficiency. In this system, there are generally no restriction on how profit is made as long as the activity complies with man-made laws. So unlike Islamic market, there is no religious or ethical screening process in the conventional finance. Investment decisions are purely driven by financial performance and return on investment, not by moral or spiritual considerations. Another key difference lies in the concept of the ownership. In conventional capital market, wealth is seen as private property and individuals have full autonomy how their wealth is used. The economic philosophy here is centered around scarcity, competition, and individual freedom. This creates an environment where almost any investment is allowed, even if may negatively impact the society. Okay, now let's move on the Islamic capital market. So Islamic capital market are built on the Sharia principle that derive from the Quran and Sunnah. These principles are not just guidelines; they form the core value that shape all Islamic finance activities. The Islamic capital market strictly prohibits riba or interest, gharar, uncertainty, and maisir, gambling. This prohibition aim to prevent exploitation, unethical speculation, and harm to the society. Instead of focusing solely on the profit, Islamic finance promotes justice, fairness, and social responsibility. Investment must benefit the community and reflect ethical behavior, not just financial gain. So one key feature of Islamic capital market is that all transactions must be backed by real assets, such as property or business ventures. This link finance to the real economy and discourage speculations and risk-taking without certain. Additionally, Islam does not treat money as commodity. Profit must be earned through productive activity or trade, not simply by lending money at interest. So overall, Islamic capital market promotes ethical investing, where every decision is made with a sense divine accountability, not just to client or regulators, but ultimately to Allah Subhanahu wa Taala.
So next is about the market structure and institution involved. First point is about the world banking system, conventional and Islamic finance. So conventional bank use an interest-based model, riba, while Islamic bank follow Sharia principle, avoiding interest and using profit-sharing instrument like sukuk. So both systems aim to provide competitive return to investor, catering to diverse customer needs and making Malaysia a global hub for Islamic finance with a significant share of Sharia compliance asset. So second point is about the regulation and market dynamics. The market is regulated mainly by Bank Negara Malaysia (BNM), overseeing both banking system to ensure stability and compliance. Islamic banks are also guided by the Islamic Finance Service Board (IFSB) for Sharia compliance and risk management. So key institutions like Bursa Malaysia and various investors such as mutual fund, pension fund, insurance company play vital roles in issuing financial instruments, conventional bonds and sukuk, and also capital formation and market monitoring.
Let's start with money market instruments. In the Islamic system, short-term liquidity tools are structured to be Sharia compliant. The most widely used one is called commodity murabaha or tawarruk. It's especially common in Malaysia, used in products like personal financing and saving accounts. In this structure, the bank buys a commodity on behalf of the client and sells it to them with deferred payment. Then, the client sells it in the market to get immediate cash. Another instrument is mudarabah, which involves a capital provider and entrepreneur. Profits are shared based on a pre-agreed ratio, and losses are borne by the capital provider, unless there is mismanagement. On the other hand, conventional money markets rely heavily on interest-bearing tools like treasury bills and repurchase agreements repos. These instruments are simple, but they involve interest, which makes them non-compliant with Sharia. Moving on to the capital market. In Islamic finance, the standout instrument is the sukuk, often called the Islamic version of bonds. Unlike conventional bonds, sukuk are asset-backed and represent actual ownership of a tangible asset or a project. The returns depend on the performance of that asset, not on fixed interest payments. There are different types of sukuk depending on the contract used. For example, sukuk wakalah based on an agency contract, sukuk murabaha based on sale, and sukuk ijarah based on leasing. Islamic capital markets also include Sharia-compliant equities. These are shares in companies that meet ethical and financial filters, such as avoiding industries like alcohol, gambling, or interest-based finance. In contrast, conventional capital markets revolve around traditional stocks and bonds. Bonds give fixed or variable interest returns, which violates Sharia, and conventional stocks are filtered through any religious screening, so they can be linked to non-permissible activities. In summary, the instruments used in both systems are a clear reflection of their underlying values. Islamic instruments are built with the aim of promoting justice, fairness, and real economic value, while conventional instruments often prioritize profit regardless of ethical concerns.
Next is regulatory issue and standard between conventional and Islamic market. Conventional market are based on secular financial tradition, so they operate with interest, riba, speculative instrument and international standardization. While Islamic market are grounded in Sharia principle, which strictly prohibit riba, horror, maisir and haram activity. So first, from a governance perspective, conventional market are managed by Central Bank and Security Commission. Bank Negara in Malaysia, Bank Negara Malaysia, BNM and Security Commission play a strong regulatory role. However, Islamic market require an extra layer of oversight, especially Sharia governance, led by the Sharia Advisory Council (SAC). So the SAC certifies Sharia compliance security and revise and review advisor. So next, when it comes to standardization, conventional market follow global framework like IFRS, Basel, and IOSCO. The Security Commission, which is Capital Market Master Plan 3 or CMP3, help improve market competitiveness. But Islamic finance relies on institutions like IFSB and law like the Islamic Financial Service Act 2013. A major update in 2024 to 2025 is that the SAC changed the financial screening benchmark from PBT to total income for better fairness. In terms of infrastructure, conventional market use deposit insurance, central clearing and interbank market, while Islamic finance requires Sharia to embed at every level. Screening is both qualitative and quantitative, which business income from haram activity must not exceed 5% or 20%, and certain financial ratio must stay below 33%. SAC also works with Bursa Malaysia to reclassify industry like cinema and hospitality based on religious ruling. Lastly, on risk and liquidity management, conventional market use interest-based tools and derivative. Islamic market can use riba, so Malaysia has introduced tools like commodity murabaha for secure financing and hedging. Islamic finance is so guided by Maqasid Syariah, which aims to balance financial return with ethical and social goals. So in conclusion, Malaysia's dual market system show how global financial standard can be aligned with religious compliance. The SAC add more moral oversight beyond what found in conventional market. With initiative like CMP3 and regulatory update, Malaysia is positioned itself as global hub for Islamic finance.
Conclusion, Islamic and conventional finance are two distinct systems serving key economic roles. Islamic finance emphasizes ethics, social justice, risk sharing and prohibits interest and speculation. Meanwhile, conventional finance focuses on profit maximization, interest-based lending without ethical constraint. So, these differences shape their financial products, institutions and regulatory frameworks. Islamic finance has dual supervision, like government and Sharia boards. Meanwhile, conventional finance follow global industry standards. So Malaysia's dual system presents challenges and opportunities for ethical and innovative finance. So understand both systems help create more inclusive, resilient and sustainable financial market for the future. That's all from us. Thank you.